When companies have cash, their management teams have to figure out what to do with it. This process is called allocating capital, or really capital allocation. Sounds easy, but it's really difficult in practice. Management teams that are able to allocate capital well outperform their competitors. In this video, we talk about capital allocation specifically in terms of private companies. We will talk about investing in new projects and the other options for allocating capital. And we'll end the video with a final thought. So let's get started with investing in new projects. When companies have capital, the management teams of the companies try to invest in new projects that are both organic, such as investing in new equipment, or inorganic, such as mergers and acquisitions. The new projects, whether organic or inorganic, are used to grow revenue, such as new products or new geographies, or cut costs, such as by investing in new technology that will lower operating costs in the future. When management is looking to invest in new projects, there should be a quantitative process to make these decisions. Internal teams will usually use models that forecast various assumptions and will use a cost of capital to help determine whether or not a project should move forward. These assumptions may be subjective, so there should be clear explanations for these assumptions. Investors, it is important to look at how various members of the team are incentivized. If a manager of a specific division is only compensated based on the performance of that division, well, the manager may be incentivized to push through projects that may help the division, but not the overall company. Sometimes companies get political and have internal fights for capital. As an investor, you want to make sure that the teams are all aligned and that there is a clear process to determine which projects will be chosen. It is important that management and the members of their team are looking to allocate capital to new projects that are in the best long-term interests of the entire company, which may even include investing in projects that would disrupt their current operating model. So let's move on to other uses of capital. Just because a company has money doesn't mean that they have to spend it on growing the company. Management of companies should only spend money for growth when it clearly makes sense. Some other uses of capital are paying down debt. A private company should look at its debt situation, the interest rate on the outstanding debt, and many other factors to see if it makes sense to pay down debt. Keeping cash. Even if there are no new projects to invest in today, but management believes that there may be new projects to invest in the future, well, it may make sense to keep extra cash on hand. And paying dividends. If there are no new projects to invest in today or in the near future, it may make sense for management to return capital to investors so that investors can deploy it elsewhere for a higher return. In private companies, management may be incentivized to not give investor capital back, since management may want to keep the capital in the company for their own best interests. In public companies, company share prices are rewarded for dividend payments. So, one could argue public companies have a larger incentive to pay out dividends than private companies. One other use of capital for private companies that I should mention would be to use company capital to buy shares of their own company from certain investors. Now, this is common in public companies and is referred to as companies buying back their shares. This isn't as common in private companies, so let's leave it for now. Now, here's a final thought. Investors, when buying private companies, It is important to do your due diligence to assess the capital allocation abilities of the management team. You'll want to look at past capital allocation decisions along with the justification for them. Once you buy the company, you should have a trustworthy, transparent relationship with management, along with structures that ensure alignment of interest so that everyone is looking out for each other's best interests. If you can invest in a management team of a company that has great capital allocation abilities, well, this might be a reason that could make a private company a good private equity investment. In this video, we talk about capital allocation, specifically for private companies. We talk about investing in new projects and the other options for allocating capital. If you have any comments about capital allocation for private companies, please leave them in the comments below. Thanks for watching our video. If you enjoyed it, please click the like and subscribe buttons. And in the description below, you'll find links to our unique private equity newsletter that provides exclusive commentary on recent private equity deals, as well as our website and our LinkedIn page, where you can find more information on many private equity topics. Thanks, and we'll see you in our next video.